Music.
Okay, good morning, class. So, today we are going to talk about applying principles of financial management, and we are going to talk about sources of business finance.
Uh,
Can you see
I'm
my screen?
usually um, searching
So, what do you understand by sources of finance? By the end of the lesson, we expect to define sources of finance, identify the sources of business finance, and state the criteria used in making choices of sources of business finance. Sources of When we talk about sources of finance, it refers to where a business gets money from to fund their business activities. So, Jill, which sources of business finance do you know?
there. There is internal and external sources of finance.
Somebody to help her? Okay, somebody to read what is on the screen, kindly.
Internal sources are funds generated and allocated within the organization itself. They include retained earnings and sales of existing assets.
Yes, thank you, Jacqueline. So we have internal sources whereby we have retained earnings. These are earnings that a company gets from their sales. For example, if they sold an item or if it's the products that they are dealing with, whatever they get as profit, they plow it back to be used as a source of finance for the operations of the company. We also have sale of assets, whereby in case you have an asset that is obsolete or is of lesser value, you sell it to be able to get finance to operate. Then we also have external sources of finance. Which ones are these? Another person to read for us what is on the screen. Someone to kindly read for us.
We have we have external sources of finance.
We've lost her. Let me help her. So for external sources, they are the funds that we obtain from outside the organization so that to meet financial requirements. They include equity financing, debt financing, trade credits, and bank overdrafts. Who can explain to us what we mean by equity financing? Someone?
Equity financing is like the shares that somebody owns.
Sorry, cannot hear you properly. Please repeat.
Okay. I think equity financing is the financing where one comes from personal shares or something like that. I'm not
That's
sure.
correct. So equity financing is whereby you buy shares, you invest in the company. Then we also have debt financing. You can explain what we mean by debt financing.
Debt
Okay, debt financing is a situation whereby we borrow money to finance our business activities. You can borrow from your friends, you can borrow from banks or any other lending institutions, and then you repay back within a given period of time at a given rate of interest. Then we also have trade credits, whereby if your company, for example, is dealing with the sale of products or goods, you go to your suppliers and take the goods on credit, and then you repay after reselling within a given period of time, whereby you agree with the supplier the period that they will give you to repay back. We also have the fourth source, which is bank overdraft, whereby in your bank account you go and withdraw more money than you have, and then you will repay back. So those are the external sources of finance for a business. We move to the next objective, the criteria that you use to determine the source of finance to use. Anybody who can read for us the slide?
criteria used to choose sources of finance. One, purpose of finance. Two, time frame. And three, cost.
So when we speak about the purpose of finance, what do you look at in selecting a given source of finance? Anybody?
Um,
Rehema?
to help individuals, businesses, the government to save, manage, raise, and efficiently use the money to the best of its ability.
Yes, that's correct. So the purpose, also to add on that, the purpose for which you are going to use that finance for will determine the amount that you need. For example, if you need money for a big project, your friends may not be able to raise enough to do such a project. So you may opt to take a huge bank loan to finance that. The next point, time frame. Sheila, Sheila, are you there? It seems she is not in class. So for time frame, we look at the time period for which that specific source of finance will be repaid. So in this case, maybe you will prefer a source of finance that gives you a longer time frame to repay back. For instance, if you are taking a loan, a bank loan, and you have two options whereby one you have 6 months to repay and another one you have 1 year to repay, you may prefer the longer period because it gives you more time to get the money and repay back in small bits. We also have the last one, which is cost. A business's main aim is to minimize costs and maximize profits. So if the source of finance that you are using is going to be more costly in terms of interest rates, you will prefer a, a source that gives you smaller interest charges. So that's the end of our lesson today. Maybe anybody who has a question to ask. or anything to add, this is your time. Any question?
No question, madam.
Thank you so much. Thank you for your participation in the class.
So I just want to add on what you have said. Criteria is to choose sources of finance. Can
Someone has
also
an
choose
addition.
to
Let's
the
listen.
period, that is the duration. That is duration. It is also a criteria that you can use when sourcing finance.
Okay, thank you so much. We've come to the end of our lesson. Thank you for participating, and I wish you all a lovely day.